Well, first of all, thank you, early birds. You guys got here on time, and you got prizes to prove it. Just as some general housekeeping before you even get to know who I am, washrooms right outside. You passed them if you came through the front doors. They're on the right. They'll be on your left side as you walk out this door. These tickets are to try and attempt to turn a subject matter like taxes into something that we can all stay wide awake. Not to say that Larry can't keep us awake, but I was raised by, my name is Aaron Gall. I'm with Urban Trans. I'm a director at Urban Trans, and this is Larry Filler with LF Consulting. We are strategic partners of 511 Rideshare. 511 Rideshare is continuously improving its programs, and it's always reaching out to have these sort of opportunities for employers like yourselves to come together, some little bit of strategic networking and to see that you guys aren't alone in what you're up to, but also to provide an opportunity for you guys to learn something from perhaps an outside expert. And there's probably no better expert for tax benefits than this guy right here, who I'll tell you a little bit about more in a second. So I was raised by an elementary school teacher, and part of what she was able to do was find really interesting ways to keep me paying attention. All throughout my life, she still does this. And that's where I got these little coupons. This is something my mom used to do when I was very little. So basically, if I see good behavior happening in this room, so don't be bad, you're going to get more tickets. What are these tickets for? In the back of the room, you'll see 5 gift cards. This is just a fun way for us to perhaps be rewarded for trying to stay awake and have a good time, pay attention, learn some great tax benefits information. So if you're not familiar with how these things work, you keep one and you get rid of the other one. So you'll put whichever one you want in there, and part of my passion is behavioral economics. So I'm going to be judging you based on which one you put it into, because there are different denominations, there are different things you can win, etc. So with that being said, that's what these are for. And welcome everyone for coming. Today's an exciting day. Again, I want to just briefly introduce the 511 team who brought us together here today. We have LaShawn right here, the lovely LaShawn Martin, who she is the point person for any questions you have further. I just saw Linda Furnace come on in. She's in the back. She's in the trouble table with the rest of the 511 crew. We've got Lydia and we've got Michelle, and we have Juanita, right. And anyone else? Amy Paz was on the list. Amy Paz yet? Christine. And from MTC, we have the lovely Christine, and I am going to let you tell me your last name.
Sure, it's a long name. It's mainly Dribble.
That's it. And she comes to us from the Bay Area Commuter Benefits Program. So no better person. We have a slew of experts in the audience as well, and also you guys are experts. Part of what we want to talk about today is what you go through. It's great to hear a presentation about how this stuff works, the framework, but putting in simple implementation comes from you guys. And that's where we want to work with you, help you guys help problem solve each other's problems, and share best practices if possible. So with that being said, I'm going to introduce the lovely Larry Filler. I don't like reading bios because it sounds like I'm actually standing up here reading bios. So I took his bio and I tried to classify it into subjects. So the first subject is Larry Filler is legit. And I say that because in this paragraph, and I'm just going to skim here, he basically has had 25 years experience putting together transportation programs for employers and creating alternative solutions for getting people to work. The second big paragraph here, and I'm sorry if I'm skimming over your lovely career, but I just don't want to read this.
It was a blurring.
Larry is the godfather. And I say that because he legitimately created commuter tax benefit programs. In 1987, he created the nation's first, and for many years, the largest commuter benefit program for transit and van pool commuters under the name Transit Chat. So he's legitimately the godfather. He started this. And once you start to hear his accent, you'll understand that he actually may be a godfather because he comes from the New Jersey, New York area. Prior to creating Transit Check, he was extremely busy in creating some fantastic transportation elements, including the legislation to create the New Jersey transit system. And he was a member of the team that set up the MTA Metro North Railroad. And the final section of this paragraph is he's smart. And I'm going to briefly skim through some of these accolades here, but Bachelor of Science from Brooklyn College of the City University of New York, a Master's of Science from the University of Chicago, so he went to the Midwest. Then he came back east for a Juris Doctorate from Rutgers University School of Law. Go Scarlet Knights. Oh, I got some hoop hoop.
I'll see you later.
So, no better person to bring to you guys today to talk about this subject matter than my friend Larry Filler. He's got a wealth of knowledge. My job is going to be to try and keep him corralled, because this guy can go on, and I'm going to try and keep him on schedule, because we've got 2 hours, we've got a lot of content, and we're really excited to share it with you. But before I let Larry start talking and showing off that accent of his, we just want to briefly, and I mean briefly, just go around this room and say who we are. Because there's no better way than understanding who else is in the room than just hearing your name and where you're from. And this lovely woman here has sat up front, so I'm actually going to give more good behavior points. And why don't you start us off by telling us who you are and where you're from?
My name is Maria Cambra. I work for Valley Transportation Authority in Santa Clara County. And I'm a sales and promotions manager.
Wonderful. Let's just go straight back.
My name is Todd Persay. I come from Jasper and Mountain View Company, and I am part of the HR facilities team.
My name is Sabrina T. Halcom. I'm with Jackson Family Wines and the sustainability coordinator there, so I'm up in Sonoma County.
Did you bring any samples to make it better? Go to the shop.
And I'm Stephanie Johnson. I'm the regional director of human resources for Pacific Hotel Management. I oversee HR for 8 hotel properties in the Bay Area.
My name is Stephanie Wright. I am with the company called Phone Distributors over in Hayward, and I am whatever needs to be done. That's what I do.
And our very first attendee. All right.
I'm Cleo Goodwin with AC Transit, and we have an employer program called Easy Pass, and it gets employees anywhere Easy Transit goes.
I'm Sean Martin with 511. I'm the employer services rep for Alameda County in the northwest section of Santa Clara.
I'm Carrie Wolford. Work at Hacienda Surgery Center. I'm the administrative director right here in the Hacienda Business Park.
Excellent.
I'm Gabby Valero. I'm also with Hacienda Surgery Center and I'm her assistant.
Wonderful.
Christine Bailey, one, the project manager for the Bay Area Commuter Benefits Program for NTC.
I'm Beverly Christie, Benefits Manager with the East Bay Regional Park District. I'm Angela Martinez, HR Generalist at Hospice and Development, San Jose.
Right.
Brett Margrove with Hospice in the Valley in San Jose, also an HR generalist.
Juanita Lesmeister, I'm the medical consultant with Fiber.
Jennifer Jackson, I work for the City of San Hospital, Environmental Program.
Sean Riley, Cargill, Environmental Manager.
Great. Excellent.
Dan Barnard with Polycom in the real estate group.
Amy Claus with 511 Demographic Consultant.
Great.
Joanna Hewitt with San Jose State.
Beautiful.
Tiffany Rodriguez, I'm with San Jose State as well, and I am the commute coordinator and also administer the commuter check program there.
Great. And then back in the back.
My name is Michelle. I work at 511 as the hotline specialist.
Wonderful.
Vivian Thornton. I'm the employer benefit services manager at 511.
Linda Furness, employer services rep with 511. I did Central and Southern Santa Clara County.
Excellent. Well, welcome everyone. This is going to be phenomenal. And without further ado, turn it over to the lovely Larry. I'm going to get this intimate.
I've never been called lovely that often, so I guess that's a treat for being here. And good morning, everyone. I don't think I necessarily have a classic New Jersey accent. Actually, I was brought up in Brooklyn, so I don't know. Maybe I don't sound Brooklynese either. But in any event, I really appreciate all of you turning out this morning. We're going to be talking about commuter tax benefits. And despite what Aaron said, I actually find commuter tax benefits very exciting. And the reason I find it exciting is because, like with any kind of simple program that it's applied to life, there are so many variations, so many things that can happen, and you get an opportunity to try to address them and come up with creative solutions. And I look at commuter tax benefits that way. And what's really nice about it is when we put this program together many years ago, it had a really great purpose, which is try to get employees a better way to commute, to have them save money by doing that, and by giving the employers a little something to help them with the program set up, and to make it as easy as possible. And as we go through the information I'm going to present to you, what I'm going to try to point out is a couple of things. One is why it really is basically a simple program. There's a lot of information, and employers will have to do or make decisions, a lot of different kinds of decisions in the beginning. But once they decide what they want to do and how they want to do it, it really is quite a simple program, and it's very well appreciated. So I'm going to try to give you a sense of that, how the law works, and I will take you through some of the ways that you can save money. Now, like any tax law, there are a lot of gray areas. When we put the law together, we had no concept of what was going to happen, who was going to take advantage of it, and what kind of situations there would be. And so over the course of time, a lot of things have developed which allow employers to be very creative if they want, but at the same time to follow a very simple path. So I'm going to try to point out some of the opportunities that employers have, both to increase their savings as well as to address issues that employees will encounter that may not be totally traditional. And I also want to mention, I guess, one or two other things that are important. One is we've put at each of your places a couple of resource materials, which you can use at your leisure or share it with people in your company. There's the tax law itself, so at least you'll have the text of that. There's a series of tax computations that I'm going to take you through, but so you should have that, and you can refer to it later if you have questions. And there's also an evaluation form, so I would appreciate if you could tell us how we're doing, because if we do other kinds of programs, we'd like to improve and perhaps address issues that we're not addressing here. With that, what I'd like to do is just point out our goals for the day. We're going to, one, try to give you a clear understanding of the law itself, then take you through the calculations. How does an employer get the return on investment or their tax savings, and how that can apply in different situations. Then I'm going to sort of switch over into program implementation, give you a sense of what are the kinds of things a typical employer would have to consider and how they would go about setting up a program, either by themselves or if they're interested in having a third party or a benefit provider do some or all of the administration for them. And finally, just give you a few hints or suggestions of how you can maximize the value of your program, how you could really both get more money savings than you otherwise would, as well as to ensure that your program is successful. Okay, so just to start with, I'm sure you all know this, but the reason you're here is you're covered by the Bay Area Commuter Benefits Program, which is a program that I guess became effective at the end of March. It covers employers that have 50 or more employees, full-time employees in the Bay Area. You're required under the law to select one of the 4 options. You then have to register, indicate what option you're going to be putting in place, and then begin your program setup. And you'll have until September 30th of this year to begin the program. And then you have certain record-keeping and reporting responsibilities. Your options are the first one being your pre-tax option, which you allow your employees to use their salary on a pre-tax basis to pay for transit or van pooling expenses. There's an employer-provided or subsidy component, which is option 2. You can choose option 3, which is providing free or low-cost transit or van pool services, or you can, and I think this is sort of the interesting one, option 4, which is because of your location or your inclination, you may want to do other things. You may want to do parking cash out. You may want to do telecommuting, staggered work hours, a whole host of other things, carpool subsidies. So you really have a very broad range of compliance opportunities. Well, The reason we're talking about commuter tax benefits today is because, one, it clearly governs how you can offer these benefits to your employees and how you get your savings. It does lessen the cost of compliance for you, and it provides an incentive for your employees. And even in option 4, where you're not directly dealing with a commuter tax benefit program solely, you can actually tailor some of these options so that you can fit them under the commuter tax benefit provision and affect some savings for yourself as well as your employees. Okay, so we're going to structure today's workshop. We're going to explain how the law works, what the rules of the game are. And then, as I said, I'm going to go into the tax calculations. So make sure that you understand how this is done and give you sort of quick ways to get to those savings. So you can sort of have a thumbnail when you're talking about it to others in your company. I'm going to guide you through a typical program setup. And then, as I said, show you how to make your program work for you. Now, as we go through this, there may be some things that are straightforward, maybe a little boring, as Aaron said, but there's worthwhile information. But there may be things that you may not be sure of. Maybe I said something that confuses you. So I would appreciate, we're a small enough group, if you have a question, or you want me to repeat something, or you weren't sure what I said, please just pipe up. And in fact, you may insert some coupons. If you do so, tickets. I'm sorry, it shows my regional bias, but you earn some tickets to earn those worthwhile rewards. Okay.
Just to reiterate to everyone, the little USB key in front of you has this presentation on it. So don't feel like you need to take copious notes. You got that as an electronic soft copy. You can relax your hand, have some more breakfast. Again, like Larry just said, relaxing, intimate group.
Yeah, and it also includes, by the way, the handouts that is at the table. So if you want to electronically distribute it to anyone in your company, feel free to do so. Okay, so before I start, I want you to know that I'm not telling you how to interpret the tax law. I'm giving you my best good faith effort to explain how the program works. But I urge you, if there are some situations you're not sure of, even if I've addressed that in some way, please consult your tax advisor, your CPA, any of your legal people who can give you answers that you can rely on. Just invent something happens. Okay, what I'm going to talk about first is not exactly the commuter tax benefit law, but it gives you a perspective of where this all fits in. There's actually a whole realm of tax law called workplace transportation benefits. Mostly it's familiar. You may not know the technical words for the provisions, like working condition fringe or de minimis fringe, but these all, you use these as a company day to day. And so, you will need to know some of this as you implement a commuter tax benefit program. So I just wanted to give you a very quick overview of what this is. The first is a working condition fringe, which is a property or service that an employer provides to an employee so the employee can perform the work that the employer has provided them. And it's typically things that are not directly covered by the salary or the employer, but an employee could deduct this on their tax forms as a business deduction. So this is a value of this property or service which is provided by the employer. It's an employer-paid benefit. So it's excludable from gross income, which means it's tax-free. That's another way of saying tax-free. It's not in your salary, which is normal taxable. And typical examples, which I'm sure you're familiar with, is, for example, if an employee is asked to work late at night, and for safety reasons, because their normal commuting mode is not available at late hour, the employer will provide taxi fare or reimburse them for an expense to get back home. Or if they're making a business trip, any of the business expenses. So these are all called working condition fringes, which as I said, you're probably very familiar with. The next one is called a de minimis fringe, and this is a property or service in which the value is so small as to make accounting for it unreasonable or administratively impractical. And these are things, again, it's excluded from gross income, it's provided by the employer, it can cover transit and parking expenses in certain instances, and the transit component is going to be particularly important to us as we talk about the commuter tax benefit. And an example is, for example, an employee occasionally will go to a company photocopy machine and maybe make a copy of something that's personal. The employer doesn't charge the employee or impute any value that's taxable. There may be an occasional local transportation fare for some unusual purpose that's low. But they also define transit passes or fare that is at $21 or less, which is considered a de minimis fringe. And just as a historical footnote, this was the precursor to the commuter tax benefit. And when the commuter tax benefit law, the 132F, was enacted, it replaced this provision. One of the things about the de minimis that's important to note, again, as we get into the commuter tax benefit, you'll need to know this, there's something called the cliff rule. It applies to any of the de minimis benefits, but for the transit component, it means that if an employer were to give more than the $21 for the transit in a month, it would no longer be considered de minimis. And that's not just the amount over the 21, but it's the entire amount. It's as though it's invisible until it becomes $21.01, and then all of a sudden it becomes a visible, valuable benefit that has to be taxed. So you have to be careful about that. Okay, so then the final one, which we're going to spend the rest of the time on, is the qualified transportation fringe. That's the technical name for the commuter tax benefit. It's an exclusion from gross income, tax-free, the way the other two benefits are. And it covers 4 categories, which we're going to be going into a lot. Transit, transportation commuter highway vehicle, which we call van pools, qualified parking, and then bicycle expenses. Okay, so what you need to know about those 3, these general workplace transportation benefits, is that they're always available to the employees. So I don't want to give you the impression that because an employee is eligible and participates in a commuter tax benefit program, they can't get a working condition fringe or in some cases, or access to de minimis. You know, they can get the photocopy and still get the transit benefit. So that's important. And in fact, there are cases in which if an employee, and we'll discuss this, is not eligible, and there are employees who are not eligible under the commuter tax benefit, they may be able to get some of the benefit through one of the other provisions. The other thing is these restrictions on how the benefit works, the commuter tax benefit works, which we'll talk about, may impact the way you comply with the Bay Area Commuter Benefits Program. So how you structure the program and whether it's acceptable or not will be important. Okay, so let's take a little deeper dive into the commuter tax benefit provision. Again, this is an employer-provided benefit. You have to remember this. It's always provided by an employer. So an individual who is not an employee, a W-2 employee of a company, there is some exceptions for what we call common law employees, but not an employee of a company cannot get the benefit under this provision. It's tax-free, which means it's excludable from gross income or taxable salary. And this one can be offered as pre-tax or fringe, which means subsidy, which is paid by the employer, or pre-tax, which is paid by the employee, which is different than the other 2 benefits, which are employer-paid, the de minimis or the working condition fringe. This benefit has very clear statutory limits. They vary from year to year. We put in a cost of living index into the law, which affects the cap each year. Currently, transit passes and van pools are $130 a month, or a total of $1,560. This is a monthly benefit, and typically you look at it as the cap applying on a monthly basis. Commuter parking is almost twice that. It's $250 a month or $3,000 a year. And the newest component of the law is called a bicycle commuting reimbursement, which is $20 a month and $240 a year. And we'll talk about the bicycle commuting because it's sort of like an odd duck in that statute. Unfortunately, it doesn't work too well with the rest of the statute, and I'll explain why later, but it's very different from many things. And some of the differences you'll see here. In terms of benefit interaction, you can combine a lot of these benefits. That is, an individual, an employee can get transit and qualified parking. So if you park at a BART station and then take BART in to work, you can get both. So you can combine it to a total of $380. So you can see it's a very, very significant benefit. This is, if you know that, I think the FSAs cap out now at $5,000 a year. This is clearly on the same level. It's a very valuable benefit. You can also combine van pooling and qualified parking. You can't combine transit passes and van pooling. Those are considered sort of on the same plane, but you can prorate it. It doesn't happen often, but for example, if somebody's taking transit for part of the month and decide to switch to a van pool that same month, they can use part of their benefit for transit pass and the other part that month for van pooling, but it cannot exceed $130 for both for that month. And bicycling doesn't interact with any other benefit. It's a standalone provision. So if you're getting a bicycle benefit, that's it for that month. You cannot get anything else, which is unfortunate, but that's the way the law was written. And then one thing that's very important for employers to know, and it really affects how products are used and how you set up your payroll deductions and so on, is you can't commingle. They've really, the IRS is very clear about this, that if you're deducting for one purpose, you can't use that money for another purpose. So, and in fact, and this is where sometimes the third-party administrators who provide benefit products have to worry about, is to make sure that products are used on services that maintain that separation, so that if funds on a, on an instrument, say on a Clipper card, if you had one account and you use that Clipper card for both parking at BART and transit, that would make that benefit ineligible, and there would be tax consequences then, and perhaps even penalties. Okay, so eligible employees. Again, W-2 employees. However, there are three categories of employees who don't qualify. One is so-called S corporations. These are sort of less than C corporations and a little bit more than LLCs. And anybody who's a shareholder with 2% or more of those shares can't qualify. But if that S corporation has employees, the employees can. Same thing with partners. If you're a law firm and you have partners and then regular employees, the partners are not eligible to get the commuter tax benefit. And then all self-employed people. Now, you can ask me why. There's answers for that. Most of the answers are not very acceptable. This is some of the quirks of writing tax legislation, but this is what they did. And so those are excluded. But, as I said earlier, excluded employees can use the other provisions. So, if you're in a company that has employees, for example, you might have contractors or people who work for you, who maybe they're partners. And so you can give them the de minimis benefit, or you can give a working condition a fringe at times. But you have to keep in mind, as I said before, the benefit on the working condition fringe and de minimis are employer paid. So if you're running a pre-tax program and you have employees who are not eligible because they're excluded, if you're going to give them a benefit, it has to be employer paid. So that creates some issues for some companies. It doesn't apply to all. Yes?
What about temporary or seasonal staff?
You can give seasonal staff. You can give temporary. If you're treating them as W-2 employees, they get a W-2, it's fine. And for the period in which they are actually working, you can cover their eligible expenses under this statute.
Are we mandated to? Or
No,
just an option?
no, this, and I'm glad you brought that out. Excellent. I think she deserves a ticket. You are not, tickets. You are not mandated. This is apart from the Bay Area Commuter Benefits Program. But the Commuter Tax Benefit Program is a voluntary program, like any other kind of program. And as we'll talk about later, it's very flexible. So you don't have to give it to anyone. You could give it to one person. You could give it to a person every other month. You have huge options here. And we actually set it up this way because, and there was some thought originally to making it part of the 125 cafeteria plan, because that would be easy to just slip it in. But there are so many administrative requirements that we decided not to do that. And that was a great thing because, as we'll talk about later, there are so few requirements. That's why this is, I consider it a beautiful program in many ways, because it really gives the employer so many options. And that's why maybe it's a little difficult to set up, because they do have a lot of options. And you have to think a little bit about what you want to accomplish. So anyway, you don't have to give it to anyone. So if there you have partners, and you have employees, and the employees get the pre-tax benefit, you can say to the partners, I'm not going to give you anything. Okay. Oh, sorry. Okay, so let me just talk a little bit about the difference between pre-tax and subsidy. It's important because there are different requirements, and it has different implications. The pre-tax, as you know, is a set aside of a portion of current salary. It's not future salary, that is, that you're going to get a raise next month and so on, so we'll set it aside. That's different. This is when you have current salary and you give the employee a choice between getting the money as salary or in terms of the benefit. That's pre-tax. It has to be prospective. This is very important. Someone can't come into the company or decide later, I want to participate in your pre-tax program, and say, oh, okay, we'll catch you up for the year and let you, get the benefit for the months you missed. Can't do that. That is prohibited. It always has to be prospective, and it has to be an election by the employee, whether written or electronic, until it's revoked by the employee. This is called negative election. And it has to be, and so it's fixed. You can't change it until the employee. That's why some of the payroll deduction requirements are important. You have to get usually something written from the employee saying, I request that you take $60 out of my salary each month for my transit expenses. On the subsidy side, it's very different. This is employer paid. It's in addition to compensation. It can be provided retroactively. So you could come at the end of the year and say, oh, I've just started, I've decided to give everybody a transit benefit for the year, and I'll give you, the $15.60 for the entire year, if you can substantiate that each month that was your expense, the $130. And so that makes it very flexible. It's a little bit more powerful, but of course it's more expensive to the employer. But you can do that. And there's no election required. Nobody has to write anything. It's very, very flexible. So those are the basic differences. Now, you have a number of ways you can offer this. Pre-tax, fringe, and something I'll call employer assistance. Some people call it share the fare. In any event, the employer can decide how to fund this program. If the employer feels that they would like to use it, and in the tax calculations, I'll show you why an employer would do this, instead of giving a regular salary increase. But the employer could give 130, or the employee can be given the option of providing the 130, or the employer could say, okay, well, let me help you a little bit. I'll give you, say, half, and you can do a deduction up to the remaining amount. Again, the cap being 130. You can't exceed the cap for the month. And you could do that for one expense, or you could do that for another expense. So it's really up to you. Now, when we talked about flexibility, this program really is very easy to do, or it can be very hard. Employers can make it as difficult as they want or as easy as they want. It is exempt from all the other typical requirements that you're familiar with from things like FSAs and other types of cafeteria plans. You don't have a fixed enrollment time. You're not prohibited from discriminating or making a difference between groups of employees. For example, the programs that I ran, employers would often focus on categories that they had difficulty hiring in, and they would offer this benefit just for that group, so as to make it a better recruitment opportunity for them. You can do that. You can do that differences by salary level, by situation, anything you want. There's no fixed enrollment periods. You can somebody comes in, they can enroll right away, or you can have them wait. as long as you feel is appropriate. If you have a typical, say, 60-day waiting period because you go through the probation period for an employee, that's fine, you can do that. Other employers will allow this one as opposed to other. They can make a distinction because it's not part of the cafeteria plan or any other kinds of requirements. You can say, well, we'll start you with the transit benefit, but you're going to have to wait 60 days for medical. It's really up to you. And no written plans. Though I always tell employers, you really should write down at least what the program is for and some of the conditions, because it really helps the employees understand what the program is about. And if you want to impose more restrictions than the statute requires, again, it's very flexible. You can make it as more restrictive or less restrictive. So if you do have it more restrictive, it's a good idea to put a written plan into place. And a plan is really, it's not a technical term. It could be just a memo that you send out to everybody, and that's available in your recruitment package or your new employee package. And there's something called a use it or lose it rule. You're all familiar with that with FSAs, where at the beginning of the year, the employee has to estimate how much their medical costs are, and then at the end of the year, if they made a mistake and they overestimated, they lose it. Well, in the Commuter Tax Benefit program, that money stays available as long as the employee is participating in the program or is an employee of the company, whichever comes first, that is, leaving the program or leaving the employee. And it just rolls over constantly. But you always have to keep in mind that the monthly limitation applies. So you can, we've seen employees accumulate unbelievable amounts of money in their accounts, but they can't use it all in 1 month for eligible expense. So you have to keep that in mind, but that's very flexible, and you can adjust things, payroll deductions and other things, to account for those kind of rollovers if you want. And it is very flexible. Oh, by the way, the exceptions for use it or lose it, and I'll talk a little bit about it, but it's when an employee leaves the program. There is a forfeiture provision on the pre-tax side. You can never get the money back in cash. Always remember this. Once somebody sets aside that money for the benefit, for one of the eligible expenses, that money can never come back to the employee in terms of cash. You have to use it, or when they eventually leave the program or leave the company, that amount of money is forfeited. Yeah?
So with regard to the fixed enrollment periods, I know there are none, but if we write a plan, can we say, the enrollment will be during this open enrollment period, and
yes,
you can't come in July
right,
if you didn't enroll?
Right,
okay,
right. And because of the popularity of this particular program, I mean, employees really like this. You always get gripes about that. So if you want to, if you have a written plan, obviously you have to abide by it, but keep that in mind, that that's something you don't have to do, but you're absolutely allowed to do that. And then you're flexible. You can have different work sites, and this is important for the Bay Area Commuter Benefits Program. If you happen to have multiple sites, you can actually tailor it very differently. You can actually not give one site. You can say use option 4 in do a lot of telecommuting or whatever, and then use option 1 for other sites. That's absolutely possible under this law. Yes?
So for the different work sites, do the work sites each have to have full-time employees? We have some that are, there may be temporary workers there. Does each work site have to have more than 50 full-time employees, or is that going to be a whole company?
No, that's for, there's a difference between being subject to the Bay Area Commuter Benefits Program, that's that 50. For the Commuter Tax Benefit, there is no number of employees that drives whether or not you can participate. We have companies, the program I'm familiar with, we've had tens of thousands of companies who had 2, 3, 4 employees, and then other companies that have had thousands. And so it doesn't matter. So you can differentiate if you have one work site with no full-time employees and all temps or all seasonal employees, you can provide it there, and even if it's only one. And if you have another work site with all permanent employees, you can provide the same or a different program. Again, that's why you have all these choices, and that what creates the appearance of complexity. But in fact, it gives you a lot of options, and you could tailor it any way you want. So yes.
And again, to clarify, if you have one program at one site, do you have to have something else at the other site, or do you provide nothing at the other site?
The latter. You can provide nothing. It's totally up to you. So if you want to address a particular problem that is particularly susceptible of solution using the commuter tax benefit, say you want people in one, everybody uses transit there, but the other site, nobody uses transit because of its location, then you can just do the transit benefit at the transit site and no transit benefit at the other site because it's just inapplicable. So that's fine. Okay. Let's see. Okay, so I'd like to turn our attention before we're going to come back to the statute again and talk about the kinds of services and how that works. But before that, I really want to go through this return on investment or tax calculation. So you have your sheets, you can look at it, or you look at the screen, it's the same. But I want to take you through a hypothetical employee who earns $75,000. And I'm going to be this is very rough estimate in terms of their tax rate and so on, and what the employer, corporate, and rates are. But just to give you an example how this all flows, the employee exclusion is based upon, the tax exclusion is based on federal, state, and in California, there's no, I guess, county or local taxes. Other states do have that. But here, you have a state tax, you have federal tax, and you have what's called FICA, which is the Federal Insurance Contribution Act, which is the Social Security tax, which is a 6.2%, and then you have a Medicare tax. Now because this is a $75,000 salaried employee, you don't have to worry about the limitations on the Social Security tax, and your accounts department knows all this. But just for your information, the 6.2% is taken out the Social Security up to a certain salary cap. And it goes up every year. It's $117,000 this year. So if somebody's making $120,000, after they hit $117,000, they no longer are paying Social Security tax, but they pay it for the first $117,000. And then there's a Medicare tax of the 1.4%. That doesn't have a salary cap, just keeps on going. So the whole thing, so for a $75,000 employee, they pay the 7.65%. And so this hypothetical employee at $75,000 has a tax bracket of almost 42%. The employer has one exclusion that applies to pre-tax, and that is the FICA. Now, there is another tax that the employer pays, but it turns out it's very small. It's called FUTA. It's a Federal Unemployment Tax Act, which pays for federal unemployment, and it's 6% up to a cap of $7,000, but there's a peculiar tax credit that the employers get, 5.4%. Most states get it, so it passes on to the employer. So it actually turns out to be 0.6% of $7,000 is $42. So I wouldn't worry about it at this point. In any event, so we just deal mainly with the FICA. So here's how the calculation works, and there's a lot of different ways you can sort of present the savings to an employee, but the way I guess a lot of people do it is they look at the take-home pay. And by the way, this benefit happens as people get take-home pay. They don't have to file employees don't file forms or do anything. It's just they're getting more money. And the reason they're getting more money if they participate is because if you're getting a monthly salary for this $75,000 employee of $6,250, let's just assume they get one salary adjustment a month. They and they don't participate, they're paying the full taxes on that $6,250. And so their take-home pay, after they use after-tax salary to pay $130, say, for their transit expenses, is $34.98. But if there's another person who's participating, they can use the $130 before the taxes are taken out. So they're actually lowering their taxable salary from the $6,250 to the $6,120. It's only a difference of the $130. But their taxes are lower because the tax base is lower. So their take-home pay is lower. And in this hypothetical setting, it's $55 a month that they're actually realizing in real dollars that they're taking home every month, or $660. which is a significant savings for people. But it's a take-home pay. Now you can do an alternate calculation, which is you say, well, how much you want to set aside, apply the tax rate, the 41.9% to that, and that gives you the same amount, the $55 savings. But this sort of helps you sort of visualize the take-home pay savings. And on the employer side, with the pre-tax benefit, the reason they're saving is the FICA they pay, because the employee pays FICA, the employer pays FICA, the 7.65%. They're paying FICA on a lower tax base, and their savings are smaller. But if you're a larger company, this can add up quickly. So for $120, now this is only for $130 for transit. If you're also allowing qualified parking or commuter parking, this could be twice or even 3 times higher than what you have here. So it can add up, and it typically, for the employers I've dealt with, they typically tell me that that it certainly helps offset, if not completely eliminate, the administrative costs of setting up these programs. So that's great. It's a free program, basically. Now, there are other ways to offer the benefit, as we've seen, and it does have different tax implications, and they can be significant. And even though it costs, in this case, is a subsidy of $130, which gives the employee an additional $130 take-home pay, because that's totally exempt from taxes, and it's in addition to their current compensation. That's equivalent to getting for the $75,000 employee, assuming the tax rates are accurate. This person has just got a 3.6% raise from that. Now, does it cost the employer something? Sure. But if they give $130 subsidy, and again, this is all hypothetical, these are sort of standard idealized tax rates, but if the corporate rate is that, which is the theoretical 8.84% California corporate tax rate, and the federal one, forgetting all kinds of ways to reduce their tax rate, that costs $80 to give somebody a $130 basically raise, which is equivalent to 3.6%. So it's a very cost-effective, powerful way. CPAs love this, the finance people love it, because it really makes sense. So if you're going to give a raise and your employees can take advantage of this, you can give them a choice, and it's perfectly acceptable. Now, the final one is the employer assistance. What does it really cost? So here's another quick calculation for the $130 transit expense person. The employee is going to get $65 from the company as their contribution to that person's monthly transit. So they have to pay $130 for the commuting. They get $65 from their employer, which is great. And then they also, if they set aside the other $65, so they can, on a pre-tax basis, they're going to realize their tax savings as well. So the actual final cost to the employee for $130 commuting is $37, a little over $37. To the employer, they get a business deduction for that $65, and because the employee has set aside $65 of their own money pre-tax, they get a FICA savings, so that their cost for giving this employee $65 is less than half, which is great. So an employer can do all kinds of things, and they can do all their own calculations. What is their threshold for tolerance of expenses for their employee? And so they can give up to $130, they can give down to $25, so at least they give the employee something, and it always costs them less, and it also makes the employee happy, because they get savings on both sides, which is the pre-tax savings and, of course, the subsidy. So that's really great. So the program really gives you a lot of versatility. So let me just stop here for a second and make sure, we've covered a lot, tax calculations and, the law, what pre-tax is, what subsidy is, the flexibility of the program, the restrictions. Is there anything, yeah, sure.
So I just want to clarify, the commuter parking or qualified parking, that is for parking at like a BART station or a Cal train station or something like that?
Yeah, and we'll go more deeply, because it actually covers a lot of different kind of circumstances, commuter parking, which the people have this reflex that particularly those of us in the transportation demand management industry, oh, you don't want to give parking. Well, you do want to give parking, because if parking can help an employee use transit or a van pool or carpools or a shared ride vehicle that reduces traffic, then by all means we should encourage that. And for the number of people who happen to use it just to drive to work and park, well, they're going to do it anyway. So the commuter parking has its place in trying to reduce traffic, and if it can be used very intelligently, and you can link the usage of van pools, transit, even carpools to getting the commuter parking. Again, the flexibility that the employer has to make sure that the benefits are being used the way they want it to be used are enormous. Okay, yes?
If an employer chooses to subsidize the program, would they write it off in the same kind of way through the employee checks, or or what other options are there for them to get?
Yeah, that's an excellent question. What I didn't mention, there's lots of things you can talk about, is how do you record both providing the benefit and the employer's contribution, if there is any. For the employer contribution, there's no forms or anything like that. It's however they record business deductions, business expenses. As long as they have record keeping to reflect that, then their tax people will be able to then use that when they file their corporate taxes. For the employee, there's the W-2, and I think it's box 14, where often you put benefits in that box, and you'll create a category that says tax-free transportation expenses or benefits. You could. And a lot of the payroll services and so on have already figured out what they want to call it, and you just put it in there. But it's a non-taxable element, but at least reflects, and this is, I guess, a good practice that a lot of employers do from an HR perspective, is to tell the employees the value of the benefits they're getting. And you can put it there and they can see it, but it doesn't have any consequence to the individual employee when they fill out the 1040. So they can give a copy to the IRS, but the IRS just ignores that in that particular box. So that's how the reporting goes. Any other questions? These are good questions. Oh, okay. Yes?
So if you choose to do a subsidy, do you have to do it across the board to everybody?
No.
Or do you have to, or do you say, okay, prove to me that you're commuting in some fashion?
Well, there's a rule. You've asked two very good questions. You actually should get a ticket. Two great questions. You don't have to give the same amount to everybody.
Okay.
All right. And what was his?
And how do you have them prove to you?
Oh, the substantiation.
that they're-
Substantiation is very, very important. This is something that runs through most tax law, but certainly runs through this statute. And we'll get to it when we get to products and why people really gravitate to one product versus another. As a general rule, expenses have to be substantiated. So if you're claiming an amount to use as a tax-free for an eligible expense, you must substantiate it. So you have to have some kind of record. In some cases, it's a certification they allow. Under certain circumstances, it's basically judged by the facts and circumstances, as the IRS likes to say. But you have to substantiate. However, there are products particularly in the transit area, that are known as self-substantiating. And there's a hierarchy of products. And transit passes, Clipper cards, AC transit passes, whatever, those are self-substantiating. So if you have a pass, you don't need any other records. That's it. And there's other instruments like that. Cash reimbursement is like really down. That requires full substantiation, because the danger of not using the benefit for its intended purpose is greatest for cash reimbursement. So substantiation, so you do typically have to have some evidence. So if we go back to the example of giving a retroactive subsidy to employees, because the company has made that decision they had a good year, they had a lot of extra money, and they want to sort of have everybody share in the success. And they say, okay, we're going to give everybody, cover your transit expenses for the year. You have to substantiate that. Now they can give expired passes or a certification, but you have to substantiate. Okay? Yes?
As part of the mandate, is the employer required to have a minimum number of employees enrolling in any of these options?
No. No. They can go from 1 up to, as large as they can figure out. Or they can, and as I said, they can distinguish the benefits. I have known companies who have given certain employees the parking and the transit, and other employees only the transit. So again, you have complete control over how you structure your program. Okay, so let's get a little bit into eligible expenses, which are the categories. First category, which is important, particularly under the Bay Area Commuter Benefit Program, is transit passes. It doesn't say transit, it says transit passes. And they define that as any pass, token, fare card, voucher, or similar item entitling a person to transportation. They do not use the word commuting. They do not use the word employee. And this is going to be interesting in terms of a creative use of the statute, if you want. So it's any of these devices that you use on a public or private, doesn't have to be public, it could be private mass transit service, it could be a private ferry, it could be a private shuttle, it could be BART, it could be IC Transit, anything that's qualifies under transit. They don't define transit in this statute. As a matter of fact, nobody defines it in any federal statute. They talk about it in different ways and include it, but there's no definitive definition. So it's very, very broad. And the IRS is very, generous in the way they interpret that term. So it includes buses, trains, subways, ferries, and so on. But it also includes, and this is where people sometimes don't understand, or they don't read the statute as often as some of us do, that it also includes vehicles that carry 6 or more adults, excluding the driver. So if you see that little picture down there where it says taxi, it's a minivan, that's a transit pass. So if you take a taxi that's large enough from a BART station to the work site, that can qualify as a transit pass. And depending upon the product, you can then cover that expense. So that's very possible. You can use, I was asked once, some TMAs or ride-sharing groups provide senior services, and they run people from the community to the work site in vehicles, and they asked me if that could be covered. And I said, well, what's the size of the vehicle? If it's a small vehicle, no. But if you put a minivan in, yes, it'll work. So it's these little quirks in the law, but it does cover. So we'll see later, a van pool provided by a transit operator is actually not a van pool, but a transit pass. And it's eligible under the transit pass section, not under the van pool. Yes?
So in the example of the taxi, if you have to fill it with 6 people though, right?
Nope. That's another thing that's nice about this. As we get into the commuter highway vehicle, that has other restrictions. You have to have at least 3 people on average in the vehicle. 80% of the mileage has to be for commuting. This is not. So this is a very powerful provision that transit agencies, employers, others can use and allow the passengers to get the transit benefit as a transit pass for that.
Don't the adults have to be drivers that you're taking off the road?
Mm-mm.
No?
Nope. Not at all.
Just for this particular group?
No, but it has to be, don't forget, the people who get the benefit have to be employees of a company and have to qualify under whatever kind of program. So if the employer says, oh no, I don't care if it's transit pass, whatever, it's only for commuting, it's only for your personal use, you have to be in that vehicle and incur that expense for you to get the benefit for that.
So if it was an employee who just happens to own their own minivan and they commute with one other person, that one other person gets the benefit?
Yep.
Buy a minivan.
A lot of people do. So it's very, very powerful. Okay, so there are lots of products. When we first started the program, there was 2 products, vouchers and cash reimbursement, and of course tickets and passes. And because of that, vouchers and ticket passes were recognized by the IRS, and we actually put it in the statute, that if those were available to a company through a voucher provider or through the transit property, you couldn't use cash reimbursement if they were readily available. Now, readily available, I'll talk about it a little bit later. It's gotten very complicated. It used to be very simple. But now we have lots of products. We have beside vouchers, and these are bank negotiable instruments, just like transit cash, where an operator will get like a commuter check, if I think they have commuter check in this area. They're paper vouchers, and they have certain denominations, and the employees get it from their employer or from the benefit provider. They then take it to the transit operators, and a lot of them used to accept it in exchange for purchasing their tickets or passes. They can't. It can only be exchanged for transit pass, which is the tickets and passes and so on. And there's no cash refund or exchange. Remember, I told you can never get money back. You can't, get money back if you use a voucher. Most of the transit operators know this and won't give you cash back if you buy for something that's less than the value of the voucher. Then about 2003, 2004, we introduced debit cards. These are very specialized kind of debit cards, which can only be used at points of sale at which you buy transit passes. But there can be prepaid or reloadable. It's like gift cards that have certain denominations, or they could be like regular debit cards where you have an account associated with it, and the employer, on the employee's behalf, sends the money into those accounts each month to fund it so that you could use it at point of sale. There's also direct smart cards. Clipper card is a perfect example of the smart cards, chip-enabled, fair media. There are actually IRS rulings on debit cards and smart cards, because when they first wrote the statute, they didn't exist. And it sets forth, what you can what qualifies, and the big thing here is you have to make sure that, particularly in the debit card situation, can only be used for an eligible expense. So if you go to a place that and you want to use a debit card, but they sell T-shirts as well as transit passes, that transaction won't go through. At least the system should not work for that, and it'll get rejected. So they actually have to be pre-qualified in order to be in that system for it's called terminal limited debit cards. I don't know if you've ever heard of the term. But in any case, and smart cards, it has to be if the transit operator allows a smart card, as I said before, to be used without distinction for various purposes like transit, parking, going to a theater event as a package, those smart cards are ineligible as a self-substantiating benefit products. Now the first 5, direct payment is where you just directly pay a provider on behalf of the employee for a service for a particular period. But if those 5, those are considered self-substantiating if they meet their tests. If they're not, if, for example, you use a personal credit card or a debit card that works at other locations that provide more than just the transit pass, then you have to have substantiation under what's called a bona fide reimbursement arrangement. And I will talk about a little bit about that. The cash reimbursement is always a bona fide reimbursement arrangement. Always requires substantiation. Yeah.
I have a question. So if, let's say, for example, your employer uses WageWorks.
Yep.
And you have that card, but you also have a Clipper card.
Mm-hmm.
Do you have to add the value to the Clipper card using your WageWorks card? Or?
Well, it would be in your interest, certainly. I mean, if you don't, then you have to fund the Clipper card some other way with after-tax monies. So the best thing you can do is register the WageWorks commuter card with the Clipper program under your card's account, so that it at every month it hits that special debit card, transfers the money from the account that the debit card is attached to, goes over to your Clipper card. The thing you have to worry about if you do it yourself is the timing. When does the debit card get funded? When does the Clipper card hit the debit card to fund the Clipper card account? So there are timing issues. The benefit providers deal with that. And there's also a program called the Clipper Direct, Clipper Card Direct, which actually handles all of that very efficiently.
Through WageWorks?
Well, WageWorks works with Clipper Direct to make sure that happens. Yes, so they can register the card. At least that's my been experience with WageWorks. Okay, so these are all the products, and you could have one or all. Typically, again, the cash reimbursement is only used when the service can't accept anything else. So if you have a small operator that only has cash, doesn't take Clipper card, doesn't take debit credit cards or anything, or vouchers, then you allow the employee to basically substantiate that expense and reimburse them using, it depends on the funding, but if it's a pre-tax, they set up an account, fund it every month with the employee's money, and then pay them back after. So cash reimbursement, again, substantiation critical. Always need a bona fide reimbursement arrangement unless you're dealing with a self-substantiating product. But there are requirements for a bona fide reimbursement arrangement. Generally, receipts are required, although there is provision for electronic certification in the event that receipts are not available. Some benefit providers just use electronic certification all the time. Over the years, the IRS has never objected to that, so I guess by inaction is sort of accepted. There's a timing issue for reimbursement. You know, as the employee gets their monies deducted and put into a special reimbursement account, they have to use it eventually. You can't just, remember we talked about you can always let money accumulate in the account. Sure, you can always let money accumulate in the account, but you may not be able to get it out if it's a cash reimbursement. You have to file, there's a safe harbor provision in law that says it has to be reasonable, and the IRS says reasonable is typically no more than 6 months. That doesn't mean it can be longer under the circumstances and so on, but most people follow safe harbor rules because you don't run into problems. So that means if I incur the expense June 1st, I've got 6 months to the end of November to file my reimbursement. If I don't, then the employer sets this up either themselves or through their benefit provider with rules, so that if somebody files a reimbursement claim after the 6 months, it'll be rejected. Unless, again, there's some unusual circumstances. And again, everything is determined by facts and circumstances. My experience with cash reimbursement is every program I've seen with cash reimbursement is the participation rate is so much less than any of the other programs. People do not like to accumulate receipts. They don't like the paperwork. They just hate it, and that's why the FSA accounts are filled with money, because even with legitimate expenses, people just don't want to do it. And so if you want a successful program, this is not the way to go, unless, again, you're trying to fill in for some services that otherwise wouldn't be covered by the rest of the product. Now, there is areas where even if you want to do cash reimbursement, you can't. And this is where transit vouchers are readily available, and that includes transit passes. The new test, which is very complicated, is you have to look at the cost that the transit voucher provider has to be less than 1% of the average voucher value. The shipping cost can't be more than $15. You can't have unusual denominations. The adequacy of the distribution has to be, there's a lot. And so basically IRS tried to do away with the exemption from cash reimbursement because a lot of large employers, and this goes back to 2000, were very upset because it was only vouchers, and vouchers were negotiable instruments, and they didn't want to have boxes of money sitting in their shipping department waiting to be distributed. So they lobbied the IRS to try to make it difficult to eliminate cash reimbursement. So that's why it's there. I just tell you, in any kind of program you're running in this area, there's very little reason to worry about cash reimbursement. But I'd be happy to answer any questions you have on it. Okay, so let's get into the gray area and a little creativity here. Remember I told you that the transit pass says it's a person and it doesn't have to be for commuting? Well, we know that if it's an employee for their personal use of commuting, that's eligible, and that's perfectly okay. However, there are other circumstances that could fall under a transit pass, which is, as I said, in the gray area. These include, off-hour uses of a transit pass, weekends, going on vacation. Say I want to use my transit benefit to buy an Amtrak ticket, to take a little vacation and so on. These are transit expenses, but are they eligible? Well, because or I want to give it to my son or daughter or my spouse, because I don't use transit, but they do. And it's my money, why can't I pre-tax deduct it and then let them use the benefit? So is this eligible? Well, the IRS refuses to say anything. There was actually an employer asked in a private letter ruling, is this eligible? And the IRS said, oh, and other things, commuter parking, you can't do that. But they wouldn't address the transit pass. So by implication, it said, as opposed to transit passes, commuter parking, you can't do that. So you would think, yes. And I've talked to the U.S. Treasury attorneys that are responsible for the program. They said, yes, you can because of the language, but they refused to give written guidance, which means if your company is concerned or the legal advisor or CPA is concerned, they shouldn't do it. You know, it's a risk factor. And so I can't give you advice saying, do it. All I know is the language certainly embraces that. So that's why some employers, and in fact, particularly in the subsidy case, you may particularly want to say what it's to be used for. So for example, the federal government, which runs a subsidy program for their federal employees, says specifically in their plan, it is only for the personal use of the employee up to the maximum for commuting, period. That's it. And in fact, they take back the money if you don't use it at the end of the month. So you can do it. It's really up to you and what you'd like to accomplish. The other hand is, if it's a pre-tax program, the more people that do pre-tax deduction, the more the employer saves. Yes?
And that's also subject to the agency rules as well. For instance, ETA, with the EcoPass,
Yes.
there are specific rules limiting, or not limiting, it's excluding the transferability of the pass. So,
Yes.
So you deal with it kind of on a micro level.
Yes. No, that's a very good point. And
So different agencies have different rules.
yeah, that's right. That's right. But there is always incidental use, I have to tell you. That even in companies where, you know, if you buy, you know, like some transit agencies don't have time-based passes. They have, you know, you have to buy for each trip. And, or you might get a discount on a multi-trip pass. But, so if you have a monthly pass, an employee uses it for commuting legitimately, but they also use it at night or to go in the weekend and so on. That's not, that doesn't bring the program out of compliance. That's considered an incidental use. You've complied with the basic purpose of the statute.
As Larry's handler, I'm going to pass him a quick note on where he is in his time frame. Allow him to hydrate, because I have to keep him hydrated. And anyone that came in after we did about a round of introductions, we would just love for you to say who you are real quick and give him a chance to breathe. So anyone who it's not, you're not in trouble. Who didn't come in before we introduce ourselves? Here we go.
I'm Sean Luttrell, HR partner for BD Biosciences in San Jose.
Beautiful.
Angela Sip, Public Communication Specialist, Transportation Authority.
Lovely.
Alicia Stanfield, Director of Business Development for Bowers Transportation.
Oh, good.
Stuart Baker with Edenred.
Okay, great.
Hi, Stu.
Guys, buddies?
Well, Stu is one of the originals, so he knows a lot.
Robert Ramirez, City of Concord Economic Development.
Beautiful. Wonderful. If any of you guys are wondering why I'm running around the room handing out little green pieces or orange pieces of paper, there's gift cards in the back. Oh, we have another one. I'm sorry.
Mark Stamps, Contra Costa County Conservation and Development Department.
Wonderful. Did I miss anyone else? Ah! Here you are.
Captain Young for the Kansas.
Great. Good. All right. So little orange pieces of paper. You ask a question, participate. We're going to be able to put it in to get a gift card in the back. There's 5 different gift cards. You get to put it in there. So with that being said, I'm going to put it back over to you, Larry.
Thank you for my timekeeper. I forget. I get very involved in this. Okay, we're going to move a little quicker now. Okay, so let's go to van pools. As I said, there's a more technical definition than under transit passes. Commuter highway vehicles, you have to have seating capacity of 6 or more, excluding the driver. 80% of the mileage has to be for commuting, and And these are average, 80% on average on a month, and a minimum number of riders. Occupied seats is 3. There are, yes?
Including the driver.
No. Just passengers, 3 or more passengers. Van pool types, employer operated, employee operated. There are lots of ways. Employee, they have their own minivan, they want to do that. And then there are companies, third-party companies like, used to be called VPSI, it's now called V-Ride here, and Enterprise van pools, and there are others. And those are third-party, and you can work with them. The eligible expenses for the employee-owned, it's a typical kind of operating costs for that, and that's shared among the users, and that's there for the eligible expense. It could be employee leased through, say, a V-Ride, or it could be employer-owned. If an employer has their own van and provides as a van pool, then that qualifies. But the issue is, how do you value the benefit to the individual employees? And so to make sure, because you always have to make sure, remember, you're dealing with a cap of $130 a month for a van pool, and so you have to make sure that the value that you're providing doesn't exceed it, because then you're required as an employer to tax the excess over the amount. So there are 3 tests that the IRS gives you. You can do the actual value of operating that van. There's something, the commuting rule I find is the easiest one, which is just $1.50 per trip for an employee. So it's $3 a day. So it's an average 21 days in a month. That's $63. It's under the cap, you're fine. And then you can also use the normal IRS mileage rate for the cost. Okay, that's for van pools. Then we get into qualified parking. Now, qualified parking is defined in the statute, at or near the business premise of the employer, but it's also on or near a location from which the employee commutes to work by transit, van pools, carpools, the only place in the statute where they actually have a relationship between carpools and the benefit, and by transportation provided by any person in the business of transporting a person for compensation or hire. Doesn't have to be seating capacity or anything. So you can drive to a paid parking lot and get a cab, or get a shuttle, or a dollar ride van, or whatever. I mean, there are a lot of different options, and that parking would qualify for it. Now, this is related to commuting, and it's for the person. It's for the employee, and that's specifically in the statute, again, unlike the transit pass, or, which we'll talk about later, the bicycle. So it has to be the employee for their own personal use, and it has to be for their use in commuting back and forth to work. But it doesn't include residential parking. Okay? So even if the residential parking is 2 blocks away from the employer location, if it's used for residential parking, it's ineligible, and you can't get it. And lots of employees like to ask that question. Yes?
So if we already provide parking, but the employees drive alone, is that eligible parking?
Do you charge for it?
No.
Okay. Well, it's free. Then there's no cost to the employee, other than, and now you can do, you might be able to. It might be an imputed value. Often that's very different. The valuation issue of parking is extremely difficult for the IRS. They've given some very rudimentary rules for that. So if you're located in an area where there's paid for parking lots, then it's the market value of that area. Then there is a value, but then you're giving it as an employer paid benefit. It's free to the employee. So if it does exceed $250 a month, then yeah, there's a tax consequence. I'll tell you a story about that. When we first did the statute, the value of the parking was $155, and members of Congress gave their staff free parking at the Capitol. And so when this was passed, the question was, what is the value of that parking? So the IRS said, if it's your name on the parking space, then it's worth, at that time, it was like $250, say. So you owe some money in taxes. But if you take your name off, it was $155, the exact amount in the statute. And so what happened? All the names came off the parking. So that is an issue, but I mean, you have to wrestle with it. Yes?
I'm not clear on how that first bullet point is getting people
It doesn't. The statute is a compromise. This is a political compromise. When we put it into place, there was the oldest working condition fringe benefit was free parking. And under the old 132D, working condition fringe, an employer could give an employee any amount of free parking. It could be $1,000 a month. It was still tax-free. When we came along, we wanted to eliminate that. We were trying to get rid of that because of the impact on traffic. And we couldn't. So we had to make a compromise. So we brought it down to $155, and the amount of revenue that was generated from reducing a cap, reducing an amount on a fringe benefit, it gives you revenue into the Treasury. We use that Treasury, that revenue, to raise the amount from $21, which was the old benefit under the de minimis, to $60. So it was a compromise. The Senate voted for it because they protected companies that were located in major metropolitan areas where parking costs were high. And so we determined 155 protected everybody. That was it. And to this day, that disparity exists. So if you ask the question, why in the world is transit 130 and parking 250? What sense does that make? It doesn't. It was a political compromise that went back to 1992. Okay. Anything else? All right. Moving on. Lots of different types of eligible parking, commercial lots, employer-owned, commuter park and rides. And here's an interesting aspect of qualified parking or commute parking that people don't realize. It's all kinds of vehicles. It's not just a car or a van. It could be a truck, could be a motorcycle. It could even be a bicycle. So it could be a single occupant vehicle like a motorcycle or a bicycle. If that person who's using that vehicle is paying for parking at that facility, if a bicyclist needs, leases a storage locker or has to pay for some security to watch their bike for the day, that's an eligible expense. So bicycling comes in here. The issue comes when you do van pools and carpools because you've got a lot of people in a vehicle. Does everybody get the benefit? And so it's not 250, but it's 250 times the number of people that qualifies. Well, they have something called the Pride Member Rule, which says no, that somebody has to be designated as the responsible party for which the tax consequences apply. And so whether it's a van pool or a carpool, there's only one person who can get $250 to cover the eligible expenses, and that person then has to pay for all of the costs for that parking. And so there's no accumulation. And if it's a carpool of an employer or a van pool of an employer, or all the employer's employees, the employer could designate who the responsible party is. But if it's not, the employees could get together and just say, okay, you are going to be responsible, and if the parking space is more than the benefit, then we'll chip in the rest. The final provision, which was put into the statute in 2008, is called the Qualified Bicycle Commuting Reimbursement. This is defined as any employer reimbursement for reasonable expenses incurred by the employee, again using the term employee, for purchase of a bicycle, bicycle improvements, repair, and storage. And it has to be regularly used for travel between the employee's residence and place of employment, commuting, right? And this is only a tax-free employer-provided benefit. It's an employer reimbursement. That means it's employer-paid. It's a subsidy. It's capped at $20 a month, $240 a year, and it cannot be used with any other commuter tax benefit. So if you're riding a bicycle to the train station, and you get $20 for covering your eligible expenses. You have to, change the tire or whatever you got to do, and for that, keep that bicycle in tip-top shape. And you want to get a transit benefit for the train, you cannot get it. You've made your election, but you can drive to the parking lot, get a qualified parking, and then take the train. So the statute is not, whoever wrote this the way it was, unfortunately, had very little input by any of us in the industry. But in any event, it's unfortunate for a number of reasons. So, but it is available, and but there are certain issues that you have to recognize. One is, what are the reimbursement mechanisms? Okay, they talk about, you know, a reimbursement, an employer reimbursement. Well, what is that? Is it cash reimbursement? Well, that's probably okay. Can you use a voucher? And there are providers that use bicycle vouchers. Maybe it's okay. It doesn't say anything. They've never really addressed it. Can you use debit cards? Can you use direct payment? What can you do? No word from the IRS. So that's a gray area. Types of expenses. I just got a question this morning from a transportation agency in Virginia. And they said, is bicycle helmets, safety equipment, or bicycle gear eligible? Statute doesn't say anything. Talks about safety equipment, repair and maintenance. So what do you do? We know from a private letter ruling that just came out last year that you can't pay for bike share fees. So, you know, the annual membership or the daily membership, they say that's ineligible under the bicycle reimbursement. And they cite the exact words of the statute, which would lead you to believe that it has to be safety, you know, repair, maintenance, purchase, and that's it. Which seems to be a little bit, you know, narrow-minded in applying these things, but that's the IRS. They use the language. So this is something difficult. And then what is regular use? I saw a Department of Justice, U.S. Department of Justice, one of their divisions, said if you use bicycle once a month, then that's once a week, that's regular use. Okay? So is once enough? Is two enough? Three? You know, what is regular use? So there's a lot of ambiguities here, and I think that's all of these problems with this provision, I think, has really impeded its general use, and because it has to be a subsidy. So if you offer somebody a subsidy or a pre-tax, but they have to choose, and you could do that. You know, some companies don't like that. They like all pre-tax or all subsidy. Yes?
And this is a change, right? It used to be a pre-tax offer previously?
Nope, never did.
It's always been...
There were some providers who initially interpreted it to be pre-tax, but people quickly pointed out that this provision says explicitly that it's excluded from a section of the code which would allow it to be pre-tax. So that became clear. So the private letter ruling that I cited about the bike share also mentions that it has to be a subsidy. So unfortunately, no. I mean, can I tell you? Yes.
So for reimbursement, if you buy a bike to start riding, you know, regularly, you know, it costs $200. Would you get $20 and you put in that reimbursement of $200 and every month you get 20, or is it you only get 20 for this reimbursement period? That's the end of that.
Yeah, that's a really good question. My inclination, it's not legal advice, my inclination would be that I would, you know, allow it over the year. But the face of the statute seems to be like an expense, a one-time expense. What bicycle can you buy for $20? Let's put it that way. So common sense would say, okay, for the year, if I've purchased a bicycle, I could get reimbursement. But what can I tell you? This is not the greatest statute. All right, I wanted to bring up one thing that is not part of the commuter tax benefit, which is mentioned. There's actually, as you know, a law in California for parking cash out for, I think it's employers with, is it 50 or 100? I'm trying to remember which it is now. I think it's 50. That under certain conditions have to offer a parking cash out. But it is a strategy rather than a tax benefit. And parking cash out is a strategy to encourage employees who feel that they are locked into parking because they're getting subsidized parking to have other options. Because if you're given, we know from surveys and so on, if an employee is offered money to park and nothing else, they'll drive so they can park and get the money. So this was an attempt back in the 90s, and it was originated by Professor Shoup at the University of California to sort of find a way to unlock that money and give people choices. And he called it parking cash out. So employees can, a company can say, I'm going to give you a choice. The parking that we provide you is, you know, I pay $100 a month for each spot that I give you. And I'm going to now say you have a choice. You can still park at $100, and under the statute, it's tax-free because it's within $250. But if you don't want to park, I'll give you the $100 in cash. And you can do whatever you want with it, but if you're going to park, you're going to have to pay for that $100 yourself. And so they found that 17% people who did that, and there's other surveys, basically change their commuting mode. Now the cash is taxable, but you can put it in as part of the commuter tax benefit. You can say if you choose a tax benefit eligible commuting mode, then we'll give you the benefit as tax-free. So if you choose transit, we'll give you $100 as a tax-free benefit. If you choose van pools, we'll give you $100. If you park someplace to take transit or van pools, we'll let you use it for the parking and for the. But if you take it for carpooling only, or you just want the cash, then it's taxable. So it's fine, and it works, and it's I think an important way to do it. You have to look at the types of parking. You have to value the parking. There are reasons why companies will do it. For example, if hospitals need parking space for the patients and their visitors, and they don't want their employees to park there, and they charge for parking, then they might want to free up some of the spaces. There are legitimate reasons in addition to transportation reasons. And of course, you have to look at what's available transportation options. If there are no other transportation options, then people are not going to do it. But if you encourage carpooling or there's transit access and so on, then it very well may be worthwhile. Okay, so I only have a short time for putting up a program in place, so let me talk about this. The basic way a program works is, there's a lot of decisions that an employer has to make up front. But once that's made, it works relatively simple. And as the employee gets benefit funded, they get a product, and they use it every month. And that repeats itself month after month. And it's almost automatic. So it's a very efficient and easy program in the long term to run. But initially, you have some key decision points: administration, funding, eligibility, and program scope. The funding, as we've talked about, is the employer has to make the decision. How am I going to fund this program? Employee, employer, combination. Will you allow post-tax deductions, often the transit expenses or van pool expenses, or maybe even the parking may be greater than the caps? So you can allow for post-tax deductions to go into a funding mechanism that pays for these benefits. Will you allow the full monthly limits? Why not? If you're going to do a subsidy, then there's reason maybe not to, but then you can allow the employee to do the pre-tax deduction up to the remaining amount. In terms of eligibility, you have to decide. We've heard some questions this morning. Who's going to be eligible? The Bay Area Commuter Benefits Program says it has to be all covered employees, which are 20 hours or more per week. But you can do it for 2 hours a week. But remember, you're covering actual expenses. So if you have an employee who works only a day a week, then their expenses are going to be a day a week. It's not going to be the same expenses as somebody who would be for a full-time employee. So you can allow that. If certain employees are not eligible, what are you going to do with the people who are not eligible? You can use the Minimis benefit or not. It's really up to you. Do you have waiting periods? Do you want that? Do you want to let part-timers get the program, interns who get paid, locations outside of the Bay Area? Everything is really up to you. So you have to set the program parameters. That's very important. And the scope. What are you going to give? When we started the program, it was many years ago, it was just transit, so that was easy. Now you have transit, van pools, you have commuter parking, you have bicycling. So what do you want to offer? Do you want to differentiate them? Do you want to limit their use? As I said, if you want to expand the transit pass benefit, that's up to you. You can decide if you want to do that and if you feel comfortable with that. Do you want to, if you provide a subsidy, do you want to reclaim the amount that's not used at the end of the month or claw back that amount? You can. You don't have to. You can let it roll over. There's no requirement either way. But you have to make those kind of decisions. And is the bicycle reimbursement, you know, you have to define certain things. Certainly regular use is one of them. So you have those kind of initial things. Then the next really biggest thing is the administration. And, you know, the administration involves a number of different things: enrollments, payroll process, benefit distribution, and the usage. You know, in the enrollment, you know, you have eligibility testing, because if you define who's eligible, who's not, then you have to make sure that the person who's enrolling is in fact the person who's eligible or is the intended employee for this kind of benefit. You have to look at the types of benefit expenses, the amount of deduction, pre and post if that's appropriate, which benefit products. So there's a number of enrollment issues. There's payroll processing. You have to do an election. You have to have something in writing. You have to do figure out when the payroll adjustment occurs, because if you're using a third-party provider or benefit provider who needs their money at a certain time, you have to make sure your payroll deductions occur at a time that allows you to send the money to that payroll to that benefit provider. There's a distribution. You know, what kind of products, how are they going to be distributed or funded, and then the usage. So in terms of administration, to look at all those issues, you got three options really, but two categories. Self-administration. If you're small enough or your sites are small enough and you want to do this, you can do it yourself. It's very possible. Employers for many years have done this themselves. Or you can use some of the services that are out there that provide you some assistance, not full administration, but some assistance, mostly in the terms of sending you certain kinds of products in bulk for you to distribute. And then ultimately, there's the full administration option, which is the provider. So if you want to do it yourself, you've got to handle a number of things. You've got to communicate to your employee. If you're very small facilities, you can just talk to people. You've got to determine your eligibility enrollment, the funding. You have to do your own ordering and so on. And you do your own customer service. Somebody has a complaint, who do they go to? You. Okay, administration decisions are driven by the size, as I said. You know, usually the smaller companies, certainly under 50, some of them will do it themselves, although nowadays with the benefit providers being online and having, you know, much more sophisticated services, that's less and less true. Medium-sized companies and larger tend to opt towards being assisted or getting fully served by a benefit provider. Depending upon the products, you can arrange to get the products directly. You could go buy a lot of clipper cards. Or you can go to, you know, buy vouchers from a provider who fulfills your order in certain denominations by bulk. Or you can arrange with the transit operators to buy your tickets directly from them. And then so they get the products and then distributes directly. A lot of small employers like that because there's that interaction. It's amazing. The employees will line up each month to get their vouchers or tickets. And so you reinforce the value of this benefit. So for morale purposes, small employers really like that. Anyway, there's a third-party assisted. You have the Clipper Direct program, which is a really good program, and that handles a fair amount of the administration. That you charge, I think, $3 per employee per month who are active. And then there's like Commuter Check has a bulk distribution, but they also do, I think it's called Office, Commuter Check Office, which provides greater administration. Whoops. Okay, so the commuter benefit, let's turn to the full provider. They'll handle everything. The enrollment, which includes eligibility testing, usually it's online, so you can provide a file to them of all your employees, and then the employees will go online and they'll go through the enrollment process. They'll be tested whether they're eligible or on the list and so on and so forth. You get a product assignment and distribution. It goes directly to the employee, or their funds go directly to the product. They do the account funding. They handle all of that with the Clipper card. They do the customer service. They have a problem with the product. That's what they're there for. They'll handle it. They'll even talk to the transit operators on your behalf. There's IRS compliance issues, and in that sense, I mean, they make sure that their products are compliant, that the whole process adheres to the IRS requirements, and some of them will, sometimes they'll charge, some won't, will do some marketing for you, to your employees. You still have responsibilities. You got to sit down with them and you have to say, well, I have to determine who's eligible, what the program options are. I have to set up a payroll schedule, because only, the employer has to do the payroll, although there are options for that, even for that. There are monthly payments, because some of the, by the way, not only the typical benefit providers that you normally think about, say WageWorks or Commuter Check or Edenred or BRI or so on, but the payroll companies, all of them, nowadays provide some form of benefit in this area. ADP, Ceridian, and so on. Paycheck for the smaller companies. And anyway, so they're very aware of how to do this. So they work with you, and you have to sit down with them to set up the program. Okay, so here's a little boxes. I apologize for how it looks, but this sort of gives you a process flow. You set the program parameters. You provide a file of eligible employees to the provider, or you somehow get that information to them. You set up your payroll arrangements, including timing, the deduction schedule. You announce the program to your employees. You have to designate somebody in your company who's responsible with your Bay Area Commuter Benefit Program. Perhaps it's the same person. You set the enrollment timing. You review and approve monthly enrollment. You always have to do that because people are moving in and out all the time, and the amounts might change. So somebody, that administrator that you've designated, has to be, that's part of their job. You have to arrange for the payroll deductions, and you have to make your monthly payment. So this is sort of that schedule that you have to follow. So the question really comes down is, if you want all of this done by a third party, so how do you select them? And there's 4 areas. There's financial, competency, services, and experience that you really have to look to. Financial, they all charge fees, but they charge different fees, and they charge by the size. You can negotiate, so it's worthwhile finding out. They could go from $253 to $7 or $8 a month for each active employee. So you have to find out, and it's a good idea to know they're stable because you're sending money to them to handle for your employees. And if they go out of business, you're a creditor, and you may be an unsecured creditor, I don't know. So, you have to make sure that these companies are financially stable. You have to look at their competencies. What is their experience? What have they been able to do? What is their knowledge of the IRS? Do they keep up to date with it? Do they send you notices when the cap goes up? And as I said, because of the COLA, the cost of living, that happens. Oops, am I running out of time?
5-minute warning. What can we do in 5 minutes?
All right, I can do a lot, and so on. And then you have services. What are their online capabilities? Their file handling capabilities. Can they take your file and upload it efficiently, and so that there's not a lot of work, or you don't have to make a lot of changes in the files? Can they interact with your payroll system? What kind of customer service? What hours? How good are they? How responsive are they? Do they know about privacy restrictions? You're handing them a lot of information about your employees. Do they have controls over that? Do they report to you so that you can report back to the Bay Area regulators as to how your program's going? You don't necessarily want to sit there and compile your own reports if they can do that. And then experience. How long have they been in this business? Where have they been in this business? Do they even understand the region? Do they know the transit operators? So, you definitely want references. So how do you, sort of finally is, and this is sort of like the big issue is, you got September 30th as your deadline. I don't know how many of you have already decided what you want to do. I assume you're here because you want to find out more information before you make that decision. But you only have 4 months, really, to get through the process. So here's sort of an example of this kind of thing you may have to do, which is figure out what the program is, make your administrative arrangements. You're going to have to, move quickly. And then it's going to take, probably 60 days at least to get everything in place. Communication, enrollment. Because remember, you're enrolling for the following month. So everything has to be in place. And generally, in my experience in providing services to companies, if I can set up a good program in 60 days, I'm real happy. Okay, so let me just give you some tips about maximizing the value. Okay, the tax benefit is really probably the easiest and most cost-effective compliance route, and it has all of this added benefit to your employees. Saving money, people really like that. But you have to survey your employees, or at least get a sense, determine, is this something that your employees really can take advantage of? Because you do have other options, and there are good options. Or you could add other things if not everybody can take advantage of it. And then if there's sufficient level of interest, then you go through the decision points. So typically, if you're not near a transit, let's see. If you are near transit, this is, good. But oops. If you're not near transit, it doesn't mean you can't still take advantage of benefits. Van pool is eligible, that's important. You can arrange for bus service, shuttles, and you can use the cost of service as a business expense. The law gives you an option, that is the Bay Area ordinance gives you the option of charging a low-cost fare to the employees, which can be treated as a tax benefit. And they define it for short trips of $2 per trip, and long distance 20 cents a mile. And you can use, and parking cash out, certainly you can use the commuter tax benefit, you can do it for bicycling expenses, and so on. So there are opportunities to integrate commuter tax benefits even into areas that are not transit rich. What you want to do, you have to do, this is a requirement, you have to do it, you might as well make the best of it, get as much savings out of it, make your employees as happy as possible, and really achieve success. There's a lot of good reasons to do that. So you really want to reinforce the value of participating and provide frequent opportunities to enroll. You want to get as many people in there because that's more savings for you. You want the greatest flexibility in the program design that you can tolerate. You want to create a low bar to participate. You want to make the program very visible. I know companies that have great commuter tax benefit programs, and nobody finds out about it because they told them when they were new employees, and they never see any information again. And it's really too bad because the employees would love it. They would, really find working at that company much better, but it's not visible. So be an advocate. And the more employees that participate in the pre-tax program, the more savings. So this area is great. I mean, you have the ordinance, but you also have a lot of assistance. Aaron has introduced you a number of people here from 501 Rideshare, from the MTC, from the transit operators. They would love to help. You could go, you have a huge amount of resources online at commuterbenefits.501.org. You should talk to other employers and business organizations. That's what employers tell me. They get a lot of useful information, certainly recommendations about who to use or how to go about it, or mistakes they may have made and that you can avoid. You should talk to benefit providers just to get a sense of what they do and their services, a sense of their cost. And of course, the 511 service representatives who really are great, and they'll be able to help you a lot. Anyway,
you did it!
I did it.
Cheer for Larry!
Well, thank you. Sorry I had to race through.
And in my honest opinion, I didn't feel rushed there at the end, so that was impressive to do that. We did want to specifically build in some time to hear from you guys. And what I loved about what I saw and all the tickets I got to give out is that you guys were interacting, and a lot of, I think, your initial questions have been answered and ongoing. But we wanted to leave a little bit of room here to ask specific questions for this gentleman here who's, you got him right in front of you, right in your sights. So if you have a specific question and you want to ask him, he's here. If you have something you want to ask other employers if they've experienced something, ask that now. We basically wanted to just make sure we had some time here to have a little bit of this dialogue. So out of the gate, anyone want to earn those first 3 coupons?
So I work for a city, and so most of all our employees are in CalPERS. So does that mean then, because we're not paying into Social Security, there is less of an employer benefit?
Yeah, there are. I don't know what the legal arrangement is. I mean, I'm familiar with New York City has the same kind of arrangement where they don't pay Social Security for their employees. They have their own personal system, but they do get, through their arrangement, they get a tax exclusion for the amount they have to pay into that system. And I assume for CalPERS, but I don't know this specifically, that city agencies or members have to pay something in based upon what the salary is of the public employees and how that's treated. You need to ask to find out, but the payroll department. They usually know, or finance department. But there is, it's likely there's an exclusion there. But I don't know for sure. Those are really very specialized programs.
You talked a little bit at the very beginning about option 4, and maybe this is something offline. East Bay Regional Parks, of course, we have very remote places, so it's very difficult to take anything but a car to get to most of our locations. But all of our employees have alternative work schedules. That's not as much on the option 4, or is it? It's not?
No, some states actually have like telecommuting tax credits and things like that for the employers and so on. I don't think California, does California have anything like that?
I was just going to add, were you talking about the Bay Area Commuter Benefits Program?
Yes.
Or, yes, so I think she's talking about option 4 for
Yeah,
that
option 4.
program. We actually do have the alternative work needs. There's an option 4A, 4B, and if you take a look at those, we have an option 4 guide as well on the website. But that is included as one of the things that you could indicate you're doing.
Yeah, but what I was trying to address, and that's great, is in terms of any tax component to that. And I don't think California has anything that gives the employer a tax break for supporting that, no. Yeah, that's, anyway, yeah, it's just not, can't do it. Yeah.
So in our situation, we're an East Coast-based company and we're a field site with centralized benefits. And so we don't have a lot of support or inclination from corporate to set up through the flex spending vendor, something that's site-based through a national program. So what are you seeing, or what have you been recommending for companies that are kind of in that same situation?
Right.
We're short on interest and resources.
Okay, so the central personnel, human resource department, is not going to handle this. And so they allow you as a satellite office to put into place the commuter benefit program?
Allow is an interesting word, but yeah.
So you have more than 50 people in that?
Yeah, over 1,000.
Over 1,000, okay. Well, then, my experience is for such a sized company, you would go to a benefit provider to arrange for setting up a program just for that site. And you could do that. I mean, as long as corporate says it's okay, and you can, we distinguish, I work with companies that are both centralized and decentralized. Decentralized companies allow certain areas of the country to have a different kind of program in this than others. I mean, certain areas don't have a program, or they say they're out in the sticks someplace and there's no reason for it. But if you want the program, and this happens a lot in metropolitan areas, where a particular facility of a national corporation will have a big location, but they, won't do it except in that metropolitan area. And they let that, well, sometimes they let that company, that facility administer it themselves. Sometimes I've had to send products to Texas to send back to New York because it's a centralized company. So you have to ask them. But for 1,000+ people, a benefit provider would probably be your best route because that's a lot of administration.
And kind of in that same vein of, we have a fair amount of direct labor population that don't have computer access. And so when you have that rule about being cumbersome, or depresses participation among that population, how would a population where our expense reports are on Concur, it's electronic, and so that creates some sort of burden for employees who don't have computer access and don't.
Well, if you're using a benefit provider, I think the solution is they can give them products that don't require cash reimbursement, and they don't have to file through that electronic means. They do have to go online. Some benefit providers will allow for paper enrollment and selection and so on. And again, you need to talk to the benefit provider to find out what they can support. You can also have at the company location, computer sites or an administrator who helps some of the people enroll. And so they can come to them periodically if they have to make changes and so on. So there's a number of options. You really have to look at what works best. But as I said, if you go to a benefit provider and give them this area, you're going to get they're going to get clipper cards or something like that. They're not going to do the cash reimbursement.
Before we field the next question, we are coming upon that time, and we'd like to promise you guys you can leave when on time. But you all have your coupons in front of you, tickets. All right, you started using your words. Convincing. So what we're planning to do is utilize this last step just to thank you guys for staying to the very end. What we would plan to do is just take your chance to get up there and distribute your coupons. Again, we keep half, put in the other half, and then we'll do a draw immediately after. So taking you probably about 7 or 8 minutes after our promised departure time. And Larry is here. He's not going to run out the door the minute that that clock strikes. So if you have another specific question, please do. And finally, if you came in and you didn't get a chance to fill out that sign-in sheet, the lovely Lydia in the back, she has the sign-in sheet. If you could please, be sure to sign in. If your name's not on the list, just fill it in the bottom. That's fantastic. We just want to make sure we know who came and who dedicated their time and resources with us. And with that, I think I will leave you with the parting words.
Well, I'll take a few more questions if you're interested in staying. If not, you can come up and ask directly, or any of our assistance people here from 511 or other agencies. Yes?
Since it's a room with some of your payroll people, maybe somebody here has that CalPERS answer. Is it anybody have the answer? So I'm curious. No. Okay.
Yeah, it's a great question for further research, definitely.
Is there anything that I didn't cover, or only covered, partially, that you need to know, or questions about? Are you all? Have you decided yet what kind of program option you want to put into place, or is this still part of your decision-making process?
No pressure.
No pressure.
Haven't decided.
Haven't decided.
And remember, there's evaluation sheets in front of you. By all means, give us your unbiased, frank input. And let's get those tickets in so we can do the draw for you and get you guys on your lovely way.
Yeah, and so I want to thank everybody for your time and attention. It was a great audience, great group, and I wish you a lot of luck in your implementation. I think it's going to be a great program for you. Good luck.
Good job, Larry.
Now I want to make just a